So welcome today to our second breakfast of the year. So this is a breakfast organized by the Corporate Governance Officer Committee from ILA. We are very glad because today we have a lot of registration. About I think 80 or 90 person have registered for this breakfast. There is an increasing, really an increasing wish to participate to this breakfast for corporate governance officers. So we were keeping finding new ideas for training, and I'm very glad today that we'll have with us Pierre-Régis DUKMEDJIAN, who is the founder of DPR Tax Law. So Pierre-Régis was even a former colleague of mine at Atos when I joined 14 years ago. He has more than 20 years of experience in the tax field in Luxembourg, and he will be able today to give us tax updates to keep in mind in boardrooms with the recent developments. We know that the tax topics are always very important for governance and officers and directors. So it's good to have an update of the recent developments. I see that we have 60 people in the boardroom. So we'll start in a minute. Just to tell you that the presentation will be shared with you at the end of the breakfast. If you have any questions during the breakfast, you can send them in the chat, and I will just address them to Pierre-Régis if necessary. And at the end, we'll keep a 10-minute open discussions for questions. So do not hesitate if you want to raise any point. So thank you again for joining this breakfast, and I will give the floor to Pierre-Régis to start this session.
Thanks a lot, Richard, for the introduction. Good morning, everyone. So essentially, this presentation will provide you with an update on what is basically news from a tax perspective. And as Richard mentioned, tax is always very important for directors because obviously of the potential tax liability. The presentation will be, the agenda is the following. I will start with a brief summary of Pillar 2 and what is new with respect to Pillar 2. There is a FAQ that has been recently released by the tax authorities. I will also give you a quick general update on some topics with respect to VAT on remuneration of directors, etc. Just a follow-up, basically, of the presentation you had last year with respect to tax. And then I've picked up a few case law, which I think are of interest and which deal with abuse of law, the burden of proof, and the economic owner concept also in specific cases. With respect to Pillar 2, I assume, and I'm sure you all know this law. The law has been voted on December 22nd of last year. And the idea is to provide for a minimum global effective taxation with respect to multinational groups and large-scale domestic group within the EU. The idea, of course, is to have a minimum tax rate of 15%, 1.5. And this is applicable to multinational group or large-scale domestic group with consolidated revenue of 750 million euros. This is the same threshold, as you know, as for the country by country, basically, reporting. And to manage this goal, there was an introduction of 3 new taxes. So what we call the income inclusion rule, which is applied at the level of the ultimate parent entity or the intermediate parent entity. And the idea here is to provide for a top-up tax in case the entities belonging to the group are not subject to a tax of at least 15%. There is a second tax which has been created, which is the undertax profit rules, which is some kind of fallback plan or backstop plan in case the top-up tax at the level of the inclusion income rules was not being able to be applied. So this is to be sure that there is the minimum 15%. And the last one is what we call the qualified domestic minimum top-up tax, QMDTT, basically to collect the top-up tax in Luxembourg. And this applies before the first two one. So we start with this one, and then we apply the income inclusion rule, and then the UTPR. So of course, this is much more complex, but this is the general rule to obtain a minimum taxation within multinational groups. When does it apply? It applies as from fiscal year starting in principle. There are exceptions, but in principle, 31st December 2023. There are some exclusions. For example, investment entities, based on very specific definitions, are out of scope. And potentially, the structure which is under the exempt investment entities may benefit also from the exclusion. And when I refer to investment entities, basically, I'm referring to investment funds, for instance, or real estate investment vehicles. And when I say specific definition, if I take the example of investment fund, there is a specific tax definition in the law. And for example, investment fund is defined with several criteria, which are cumulative. And one of the criteria is that the fund is used to group assets for several investors, and at least some of the investors need to be not related. The fund needs to have also an investment policy. The idea of the fund is mainly to generate capital gains, and the fund or its management are subject to KYC or AML rules and subject to investors' protection. So you can see that there are a lot of overlaps between this definition and, for example, alternative investment funds, but at the same time, there are very specific definitions. For example, it's very important that the investors are not all related. So I think, and also one last point, all the constituent entities need to register with the direct tax authorities in Luxembourg, 15 months after the end of the fiscal years, or 18 months after the 18 months after the end of the fiscal year for the transition period. I think then what is important is in practice to analyze for the companies to which you are board members, basically, is to be sure that the analysis of whether the company or the group is in the scope has been carried out, which is very important. And even if you think, for example, that you're below the threshold because you don't meet the 750 million euros revenue, the idea is to monitor it, to forecast, for example, when you might fall within the scope. And second, even if, for example, you are on the board of entities within a group of alternative investment fund, you need to double check that this fund qualifies with all the criteria which are mentioned within the law. In addition to the vote of this law, the 25th of March 2024, the Luxembourg tax authorities released what we call FAQ, frequently asked question, with respect to very technical topic that I will just mention here on deferred tax assets and deferred tax liabilities. So with people who are not very familiar, so deferred tax assets, it's an item on the company balance sheet that will reduce the taxable income of the company in the following year. For example, if a company has carry forward losses, this is a deferred tax asset because in the coming years, this may enable the company to reduce its taxable base. And a deferred tax liability is a temporary difference between the tax books and the actual income tax. For example, if you have different rules between accounting and tax for the depreciation of assets. And this FAQ mentions that, and this refers really to one article of the law, Article 53, the transition period, with respect to deferred tax assets and deferred tax liabilities. So the relevant financial statements are the one of the Luxembourg constituent entity, so belonging to the group or the ultimate parent company. So basically the company which is at the top of the group and which has no other ultimate parent company. If the financial statements that are used are the one at the level of the top core ultimate parent company entity, then the DTAs and DTLs must be traceable at the level of the Luxembourg constituent entity. So you need to see where it comes from, basically. They provide also definition on what the word reflected and disclosed means. So reflected means in the accounts, and disclosed mean in the note to the financial statements. And in the FAQ, it has been reconfirmed that the disclosure of the DTAs and DTLs can be done only in the notes, and it is also recommended to do it the year of the transition, so the year the company becomes subject to the scope of Pillar 2, to do it the year, basically, the year preceding the transition year. So this is a bit technical, but just to let you know that this is the first time the Luxembourg tax authorities have commented this new law. And again, in terms of duties of board members, of course, the idea is to ensure that your tax advisor and also accountants, because Pillar 2 is first a tax law, but at the same time, a lot of provisions are referring to accounting and financial law provisions. And then your accountants are on the top of these issues to be sure that they implement in the right way this new piece of legislation for the group for which you are board members. So I've just finished the very quick presentation of Pillar 2. Of course, we could spend 2 days on it. And then what I would like to do is just to give you, so refresh your memories on some quite recent topics and basically where we stand on these topics. So I'm sure you all know at AT3, we've been talking about this, especially 2 or 3 years ago. So as you all know, this is the draft directive, which aims at fighting against the use of shell entities or entities considered as shell entities, so entities with no sufficient substance. And as you surely remember, there have been a lot of amendments to this draft directive. There is a gateway test where when a company is subject to passive income as cross-border activities and outsource most of its day-to-day operations and decision-making of significant functions with third parties, then if you meet these requirements, then you fall within the scope of the directive, and then you will need to report specific substance requirements. If you fail to report this substance requirements, then you may be in a bad situation, basically, where there will be the refuse of access of double tax treaties or EU directives. And as you know, this topic was quite urgent 2 years ago. We thought that it would be applicable as from 2023. And then it's in the long list, basically, of directive or draft directive that are put on hold because there was no real agreement yet on this directive. And other directive has been have been prioritized. So we have no specific news basically on ATAT 3, and we don't know exactly when this one will be enacted. So no news on ATAT 3 so far. Then after ATAT 3, I just would like to briefly mention BEFIT, which means business basically in Europe, framework for income taxation. The idea here, this is a very old idea basically. I remember when I was at Atos working on the first draft on similar project from OECD at that time. The idea is provide for common rules for big groups. So again, the threshold will be 750 million euro of revenue turnover for domestic or international group. Common rules to calculate the tax base, to consolidate all the results at the level of the top co, and then allocate the taxable base between all the members. And so just to let you know that this is still in progress, and that basically the idea is to transpose it by the 1st of January 28, and for an entry into force, the 1st of July 28. So it's not tomorrow, but it's not so far. Of course, this is a big significant change in the allocation or the determination of the tax base of entity. And it will really harmonize a corporate income tax essentially in Europe for big groups again. Then for DAC 8, so this was addressed, I think, in your last presentation, and now this has been voted. It has been adopted the 17th of October last year. So as you may know, there are a lot of DAC, DAC, Directive for Administrative Cooperation. And here, this one extends some obligation with respect to exchange of information. And the idea is to provide some reporting obligation to crypto asset service providers within the EU and also crypto assets operator outside the EU. So essentially, this is an amendment to the CRS, as you know, the Common Reporting Standard, because crypto assets were out of scope before, and now the crypto asset users need to be basically reported for obvious reasons, for tax reasons, to avoid tax fraud, etc. In addition, in DAC 8, you have other provisions. Some provision which amend DAC 6, you know, the exchange of cross-border transactions which may be considered as tax harmful. And this one says that basically intermediaries which are subject to legal secrecy will not have to report. This was already applied in Luxembourg and in some jurisdictions in Europe for lawyers, for example, tax advisor. And also, which is quite new, there is new information exchange obligation for rulings for high net worth individuals when the amount at stake are at least of 1.5 million euros. And this is a new ruling exchange of information. So this is DAC 8. Then I would like also, so with an ATAT 3 BEFIT DAC 8, I would like also to address what we call FASTER, which is the Council Directive for faster and safer relief of excess withholding taxes approved, and which was being recently approved the 28th of February 24. The idea is to facilitate and streamline the process of refund or applying withholding tax exemptions or reduction when there is a payment between jurisdictions. Because sometimes either the process may be long or there was some abuse of the process and some fraud at that time. And the idea is to streamline it and to facilitate and to avoid any abuse of this refund or exemption process. This should be implemented by member states by 1st January 27. So the new thing is the e-tax resident certificate within 3 days, certified financial intermediaries, which will be the one applying basically the rules. And there will be 2 types of exemptions procedure. So relief at source, which is the best because it's easier, or a quick refund process, because so far the refund process is quite lengthy, where basically the recipient of the income may request the refund of the withholding tax that have been withheld at source. So this is basically the news for faster. With respect to VAT remuneration of VAT and remuneration of directors, as you know, long time ago there was no VAT for the services provided by directors to entities. Then there was a circular in 2016 imposing a VAT, considering that basically the directors were rendering a service in the scope of VAT. And then there was a decision by the CGEU end of last year, the 21st of December, considering that, yes, there was an economic activity, but this economic activity in the case at hand was not performed independently. So the service rendered was not in the scope of VAT because the director in the case at hand was not bearing the economic risk personally. This case law is not applicable if the director would have a casting vote, so he would be alone to take the decision and to bear the responsibility. If he had been representing daily management of the company, or if he was part of the management committee. After this case law, very quickly, as you know, the tax authorities issued a circular saying that the application of VAT was suspended, basically, and until the lower administrative court will render its decision. And so far, there is no news, and we're still waiting, basically, the decision of the lower administrative court. So I would say, in very summary, no news compared to what has been discussed or the information you received recently. And the one last point I just would like quickly to address with you is, as you know, there was a bill of law 81/86, which was proposed recently, and this bill of law has not yet been voted. And as you know, this bill of law provides for a lot of changes in the procedural tax law. For example, in case of discretionary tax assessments, the taxpayer can challenge it only if there is a 10% gap. Non-published annual financial statements are non-binding for the tax authorities. And there is an obligation also for TP documentation, which is provided. So the only aim of this very, very quick presentation of this piece of legislation is just to keep you posted on what is new and to remind you that, of course, some of these obligations will enter into force very quickly, or some of them are possibly will enter into force or need to be followed up when you will be attending boards, and be ensure that your tax advisor basically follow all these rules and keep you updated on all the potential updates with respect to these rules. Then I would like to address the last part of this presentation, which is the case law. So of course, it's a totally discretionary, I would say, selection. But I thought that this case law would be of interest when you are reviewing transactions during board meetings, and to keep them in mind and be aware of the risk that taxpayers may incur with the tax authorities. So the first one is rendered by the Lower Administrative Court in March 2023. And this was a company which was inactive, created in 2000, inactive between 2009 and 2013. And then this company was reactivated in 2014, reactivated in 2014 to buy a real estate. And then after 6 months, this real estate has been sold with a gain. And to reduce the taxable base of the company used its carry forward losses that were generated before 2014. And the use of these carry forward losses was challenged by the Luxembourg tax authorities on the ground of abuse of law. And abuse of law is paragraph 6 of the adaptation law. The definition used at that time was, if you remember, the use, basically, an abuse of law is the use of private law firms or institutions for a tax savings, so potentially a reduction of tax, with the use of inappropriate route and the absence of extra reasons justifying the route that the company has chosen. And this was based on this. The interest of this case is not only why the court decided that there was an abuse of law, but also what is the burden of proof of the tax authorities. So first, the court said that the tax authorities need to evidence that it's plausible that the taxpayer has committed some abuse of law. So they need to evidence basically some tax reasons and that the conditions of the abuse of law are met. So the use of civil forms, the inappropriate routes, and tax advantage, which are prevalent to other reasons. But the lower administrative court said the tax authorities do not have to evidence the impossibility of the existence of any business or economic reason. This is the taxpayer that needs to prove that there was basically business reasons or economical reasons that prevail the tax advantage. In the case at hand, which is a bit, to be honest, a bit caricatural, the court said that there was an abuse of law because the only reason for the company basically for the company to do it was to use the carry forward losses. And the only explanation that was put forward by the taxpayer was to reduce cost and to take less risk because they were not sure at the time they bought the real estate that this would work. And this was not really convincing, this explanation. And the court said, basically, you use the company to do this transaction only because if the ultimate beneficial owner of the company, which was an individual, if this individual had bought the real estate and sold the real estate within 6 months, this would have been totally taxed in Luxembourg, which is not the case by using the company. So the abuse of law was considered met the conditions in the case at hand. So my point here is, or takeaway, is if you monitor a transaction and you realize that the company doesn't pay tax because it uses carry forward losses, please ensure that the counsel tax advisor of your company has checked that these losses could really be used and that the risk of challenge by the tax authorities is very low. So this was the first case. Then the second case was rendered by, again, a lower administrative court in May 2023, sorry. So it was a very classical transaction, hybrid transaction that we used to do in Luxembourg like 15 years ago. So the idea was for a Luxembourg company which held the shares of a Belgian company was to provide a profit participating loan to the Belgian company. And in Luxembourg, this profit participating loan was considered as equity. So the income from the profit participating loan was considered as dividend, which was tax exempt in Luxembourg. And in Belgium, this profit participating loan was considered as debt. The interest paid were on the PPL, the yield, tax deductible. So this was a hybrid instrument. So you had a deduction in Belgium and no inclusion, no tax inclusion at the level of Luxembourg. This was so a hybrid instrument and very popular. Then, of course, we started to have anti-abuse provision, and the first one was the one enacted in the participation exemption regime, if you remember, in 2016, which basically said that if the dividend received by a Luxembourg company from a European entity basically were tax deductible in the paying jurisdiction, then the participation exemption could not be applicable. Based on this, what happened here is that the taxpayer considered that this income should be tax deductible. And what they did to obtain the tax exemption, instead of selling the receivable that were held by the Belgian entity, and this receivable of the Belgian entity were financed by the PPL, the Belgian co sold at nominal value the receivable to the Luxembourg entity, then and repaid basically by this sale the PPL, and then Luxco sold to another entity these receivables at fair market value, and Luxco generated a capital gain or gain. And what the taxpayer said, essentially in the case at hand, this transfer from a related party to Luxco should be at nominal value, which is lower than the fair market value, should be considered as a hidden dividend distribution, and which should benefit from the participation exemption regime. So which should be tax exempt. The tax authorities challenged this based on the abuse of law theory. Basically, what they said is, based on the definition of abuse of law, use of civil form or institutions, reduction of tax, the use of inadequate route, and basically the main aim is benefit of a tax advantage. Basically, they say that in practice, the company only use this transaction, so this transfer of receivable to Luxco, and then repayment at fair market or transfer at fair market value of the receivable, this route only for tax reasons, to try to benefit from exemption, because normally what the company should have done is Belco should have sold the receivable at fair market value, then the gain should have been offset by the yield paid on the PPL, and then this yield, based on the new participation exemption law as from 2016, should be taxable at the level of Luxco, because this yield is tax deductible in Belgium, then it cannot be tax exempt in Luxembourg. And they just, to be honest, it was very clever, the way the taxpayer structured the transaction. But then the courts, the lower administrative court, followed the reasoning of the tax authorities and considered that there was an abuse of law, and refused to apply the tax exemption on the income generated by Luxco upon the transfer of the receivable. So again, here, if you see a transaction which is quite unusual, like here, if you see still hybrid instruments within transaction, be very careful because now, as you know, there are a lot of anti-abuse provisions. For example, in the participation exemption regime definition, Article 116, which says that if you have an hybrid instrument, you cannot benefit from the exemption, and you have the anti-abuse rule, etc. So be careful if you have this kind of very specific transaction. The third case I would like to address is the one, again, with a lower administrative court, again in May 2023. And this case is interesting because a company was investing into real estate, a Luxembourg company, and this company was paying fees to a Cyprus company for services in relation to the real estate investments. And the Luxembourg tax authorities challenged the deduction of these services paid because they considered that there was an abuse of law, again, based on paragraph 6 of the adaptation law. The idea of the tax authorities was to say the UBO, so the ultimate beneficial owner of the Luxembourg entity and the Cyprus entity, are the same. And the transaction has been structured this way to reduce the taxable base of the Luxco and to structure the repatriation of cash from Cyprus to the same UBO in a better way as the way that would have if there was no payment of fees, because from Cyprus, there would be less tax to be paid than if the payment was coming from Luxembourg. So this was the general idea. And also the tax authorities challenge the payment of this fee based on Article 45 of the Luxembourg Income Tax Law, which says that only the expenses incurred exclusively for the benefit of the company can be tax deductible. And here, what is interesting, so first, the tax authorities lost, so it's always interesting for taxpayer to see that you can win. And because the tax authorities, based on the decision on the lower administrative court, were not able to evidence that the UBO of both companies was the same. And again, we can make a link between this decision and the former decision I just mentioned. The tax authorities, to evidence an abuse of law, need first to prove that this abuse of law is plausible. And here, the tax authorities were not able to prove it, which is quite interesting. So the burden of proof is first with the tax authorities. And second, also interesting, the tax authorities didn't win on Article 45 because basically they were saying that the taxpayer could have done the services rendered by the Cyprus entity alone, thanks to his experience. And the taxpayer said, no, I mean, I have the choice to use the route I want to develop my business, and you don't have to make a decision or to analyze the opportunity of the expense I make. To the extent, of course, that the expense is in relation to the business of the company. And this is exactly what the court said. The tax authorities do not have to appreciate or to give an opinion on the amount of expense, on the opportunity of the expense. The taxpayer can take the risk he wants, pay the expense he wants if he thinks, irrespective of the results, even if it doesn't work, of the results to make his business work. So I think this one is also very interesting. When you analyze the risk of abuse of law with respect to the burden of proof of the tax authorities and the challenge of the tax deductibility, you can be protected by the fact that the tax authorities cannot challenge the opportunity of the expense. I think it's always good to remember this. The fourth case is one with the administrative court in September 2023. And in this case, a Luxembourg company held receivables toward related parties with an interest rate which was challenged by the Luxembourg tax authorities. And based on this challenge, the tax authorities considered that there was a hidden dividend distribution. And here, what is important is the hidden dividend distribution was accepted by the taxpayer. It was not the question at stake. What was discussed was the amount of the hidden dividend distribution. And here, again, this is interesting in terms of, I would say, burden of the proof to explain when there is an abuse, a hidden dividend distribution. The tax authorities need to prove the hidden dividend distribution so that the transaction is not at arm's length. But at the same time, the tax authorities also need to evidence the amount of the hidden dividend distribution. And there was two types of receivable. And in one type of receivable, the tax authorities were relying on an old circular of 98, which said that basically in this kind of case, the interest rate should be 5%. And the lower court said this circular cannot be opposed to taxpayers and is irrelevant. Basically, you need to make some kind of arm's length analysis and prove what should be the real rate. Otherwise, as the court said, it will be too easy for the tax administration just to challenge the rate, say there is a hidden dividend distribution, and apply some kind of discretionary rate. And in the first case, what the taxpayer did, they checked the similarities between this receivable and the transaction with consumer credit at that time, and they prove evidence. They made some kind of comparables. They prove to the lower court that at that time, the rate by banks, granted by banks for consumer credit, were more like, if I remember the figures, like 1.7%, and not at all like 5% at that time. Then the court approved this reasoning. And for the second type of receivables, the receivable was in exchange of a transfer of asset. And then there, the taxpayer took a comparable which was different. So it was no longer compared to a consumer credit, but it was compared to a vendor credit. And they took the rate that could be granted at that time by third parties. So again, what is important here is this needs to be proved by the tax authorities. And at the same time, of course, to defend themselves, the taxpayer will prove that the rate, the arm's length rate should be different. And they need to find comparable transactions. So for one, it was transaction with comparable with consumer credit. And for the other one, this was transactions comparable with the transfer of assets with a vendor credit. So I think, again, this is important. If one of your company is challenged with respect to some kind of transfer pricing issue with hidden dividend distribution, you need to ensure that the tax authorities have a real argumentation and can sustain that what they reassess is correct and can be justified by them. Then to finish, so the fifth, the last case law is with respect to the economic owner concept. And as you surely know, this is with respect to specific transaction with securities lending activity. So this is a type of transaction where a company is lending securities or shares, for example, to another company for a specific period of time, and then the borrower will pay some kind of manufactured dividend to the lender to pay for the, I would say, the rent of the shares. And this has been used for some kind of obvious provision at that time, so that if the lender could not benefit from withholding tax exemption, the idea was for the borrower, the shares, to benefit from withholding tax exemption, even if it was not the real, basically, beneficial owner. In the case at hand, the taxpayer, who was the lender, had lent shares for 2 years to a borrower. And the lender wanted two things: that the shares benefit from participation exemption on net wealth tax, and they wanted that the dividend paid or the income received in exchange for the lending process could benefit from the participation exemption. This has been challenged by the tax authorities, because the tax authorities said essentially the lender cannot benefit from this exemption because the lender, from a fiscal perspective, can no longer be considered as the owner of the shares. Then the administrative court analyzed the transaction, and first said we first need to check from a legal perspective what should be who should be the legal owner. What they did is a distinction between loan for use, so prêt à usage, and consumer loan, so prêt à consommation, because in the civil law in Luxembourg, only in the case of the consumer loan, so prêt à la consommation, the borrower becomes the legal owner. And the consumer loan is not done for free. And this was one of the main features of this transaction, is that there was some kind of fee for the lending of the shares. And based on all the general features of the agreement, the court considered that this securities lending transaction should be assimilated or was quite similar to a consumer loan. And then the borrower should be considered as the legal owner of the shares. Then the court said, you can be the legal owner, but to be sure that you are the fiscal owner of the shares, you need to be the beneficial owner, economic owner, sorry, of the shares. And this is a concept which is based on paragraph 11 of the adaptation law. Basically, the economic owner is the one who takes the risk, the economic risk on the share, and who owns, acts like the real owner from an economic perspective of the asset. The court analyzed in detail the transaction. So they said first it was for a long period of time, 2 years, even if in practice there was a manufactured dividend, which was basically in the sense that the lender could be the economic owner because it was economically benefit from income from the asset. In practice, everything was managed by the borrower. The lender was no longer really acting as the shareholder of the shares, not taking part of the votes, etc., etc. So in practice, and in view of all the specific features of the transaction, the court considered that the agreement features gave the economic ownership to the borrower. So the conclusion was quite bad for the company, of course, the taxpayer, Because then if the company is not supposed to hold shares, it means that first, it holds receivables, because it was considered to hold the receivables against the borrower. And then two bad effects for them. First, these receivables are subject to net worth tax, no exemption, contrary to shares. And second, the income on these receivables should be subject to tax in Luxembourg. So again, I think when you have this kind of transaction with securities lending for a lot of things, not only for this case law, you need to be very careful with respect to taxes for a lot of anti-abuse provision of why this kind of transaction is used. And second, when you have this kind of long-term transaction where a lot of economic features are given to another party, you need to be careful and to check whether this does not have any adverse impact at the level of the company which is lending the assets. So this was essentially the last case. I don't know if you have any question at this stage. Please do not hesitate.
Thank you, Pierre-Régis, for the very insightful presentation. I think it's always good to have a refresh because there is so much legislation going on. As you said, it's a very long list. Some topics are going on, some stop. So it's very important for corporate governance officers and directors to keep a kind of dashboard and an update from tax advisor on these topics because there is a lot. And even when you are a tax advisor or a legal advisor, it's a lot. So when you are a director and you have also other things to check and not only tax things, that's very, very difficult. And also, I think it was very interesting to see this quite number cases where the abuse of law has been used by the tax administration. So, as Pierre-Régis mentioned, always really be careful on the transactions to make sure everything has been set up carefully. And of course, yeah, Pierre-Régis.
Just to mention, thanks a lot. Just a summary in terms of responsibility of directors, I would say that do not hesitate to ask, of course, your tax advisor to provide you some kind of general update, during board meetings. And also check, as Richard said, that basically to protect also yourself in terms of duties, that there are relevant tax memorandum which are up to date because things are changing very quickly. So what was good last year might not be good this year. You cannot just replicate what was done before. And ensure, yes, that you have tax memorandum and that this covers everything and this is up to date. Of course, I'm not totally objective in saying this, but more seriously, it's very important that you have all this kind of up-to-date tax memo.
But also, Pierre-Régis, I think what was very interesting is the fact that you mentioned, I think, was two cases where the tax administration lost because you reminded that the burden of proof is on their side when it comes to abuse of law. So it's
No, so
it's
it means
also,
that
yeah.
It means, sorry to interrupt, Richard, but yes, it means that I think that it's when you think you're right, I mean, you can go for litigation basically because you can see that in some instances the taxpayer wins, and yes, the case can be very strong, and you can have good arguments sometimes. So, of course, the first case, for example, of abuse of law, specifically with the use of carry forward losses, was a bit too much. a bit too easy for the tax authorities. But there are a lot of cases where, honestly, there are a lot of good technical arguments to resist the challenge of the tax authorities.
Do we have any question in the audience? Do not hesitate. You can put them in the chat if you're not able to speak, of course.
Hello, everyone.
Hello.
Hi. It's a quick question. It's more of a reminder. I know you mentioned tax law on crypto assets. Could you please remind from when it is applicable? I just missed that point.
I think this is a good question. For the crypto asset, I think this is applicable as from 26. 26.
As from, sorry?
1st of January 26.
Okay.
CRS.
Okay, thank you.
Welcome. I think there is another question in the chat.
Yeah, there is a question in the chat, so Pierre-Régis. Could you say some words about the treatment of IFLs and the recent case law in this respect?
So basically, interest-free loans are always a bit tricky. The question is to consider with respect whether this can be considered as equity for the debt to equity ratio, or if you need to have interest rate, basically interest rate basically on this. The last case law to be honest, I don't remember the last case law on the specific, but I can double check if you want. The last case law of EFL, I think it was not so recent, but this is something you can check offline if you want.
So I think, Eric, I think Eloise and Ila can provide you the email of
I can
Pierre
provide you with a quick summary on this one. I think this was on the debt to equity ratio, if I remember correctly. But I mean, interest-free loan, I don't like, generally speaking, because you always have the issues of the absence of interest. And if it's not in Luxembourg, because if Luxembourg is financed by interest-free loan, the tax authorities will not specifically challenge the non-deductibility of tax, but the issue can be at the level of the shareholder, of course. And if it's on the asset side, of course, the tax authorities will likely to exactly. National interest. Then you can have, yes, a deduction of national interest, because if the company is in back-to-back, then the question is, would the company be subject to some kind of margin first? And second, can we have some kind of national interest at the level of the company? This is something I can check, of course, with pleasure. I don't remember by heart.
I think there is, Pierre-Régis, a new question, and DAX 7 and CRS new notification requirements.
So DAX 7 is for the seller of on remote basis, so the exchange of information. And CRS new notification requirements. What do you mean by this one?
So what I have Hamilton speaking here. So from my understanding is that there will be some new CRS reporting obligations and notifications to notify the individual clients and controlling persons of passive non-financial entities subject to CRS. So it's basically we need to notify individuals of what will be reported.
Yeah, because I think the new one I was mentioning was the one with respect to a crypto asset, basically user.
Yeah.
Basically. So this is the one that you will have to put, which is not the case before. And also now, not for CRS, but there will be, which is new, because so far, what was tackled was more in the exchange of information for ruling was more companies and not really individuals. And now it starts with individuals, basically, with the exchange of ultra high net worth individuals.
So, I mean, if there is no further question, we can end this breakfast. So I would like to thank you all again for your presence. It's really great to see that we have an increasing community participating, and a big thank you to Pierre-Régis, who was able to make this presentation on very short notice. So thanks a lot, Pierre-Régis, and I wish you all a very nice day, and the presentation will be shared with you.
Thanks a lot, all.
Have a nice day.
Have a nice day.
Thank
Goodbye.
you.
Bye.
Goodbye. Bye-bye.
Bye.
Bye. Thank